Hi, this is Rebecca with the Kat and Rebecca Show, Keep It Real Estate, and I'm with Brian Kavanagh from the Franklin Loan Center, and we've talked about VA loans, FHA loans, and conventional conforming and non-conforming loans. So now if you're not in one of those three categories, we're going to talk about alternative loans.
Okay, there's a couple different sectors to that, all right? You've got your alternative loans. Way back when we talked about the three things that we require for a loan: credit, income, and down payment or savings. If you don't have one of those three, it's going to be considered an alternative loan. There's going to be another way that we're going to have to document those funds, whether it's maybe income. We're looking at bank statements to document, or asset depletion, or some other source. You have the income, but you don't have pay stubs to show it, or you don't have tax returns to show it, okay? Or maybe the money is coming from a different source that we can't document. Or maybe you've got income, you've got money, but you've got no credit, okay? So we're taking away one of those things. Alternative loans are out there and they exist to help people out just like this. And it could be credit challenged, income challenged, like they're self-employed and they don't show any income. But when you are using an alternative loan, your terms are not going to be as competitive as a government loan or a conventional conforming loan. Okay, our risk is going to be higher, so we're going to pass that on to you, and you're going to have a higher rate or slightly higher cost to do that loan. Okay, don't expect the same exact things as you do with a conventional or an FHA loan.
So we always hear about a hard money loan. So what exactly
Hard money loan is basically, out of those three things, you're missing two of them. You've only got one left. Hard money loan is going to be strictly, the ball's going to be in the investor's court. Okay, you're going to put down a large down payment. Okay, and for the most part, we look to see where it comes from, but we don't care about the sourcing of it, so to speak. We don't necessarily look at your income. We only look to see that we have a large stake in that property. So if you do fail to make the payment, it's easy to take back.
Okay.
Okay, so now those terms are even less than alternative terms. Okay, high rates, high cost, large down payment.
Okay, now on the other alternative loans where maybe you're only missing one of those items, what are some of the terms somebody might hear if they're going in and they have one of those items missing? Are there any names to these types of programs?
There are lots of names to these programs. Most typical is called bank statement loan, okay, where we take your income based off of your deposits into your banks. Okay, we'll look at the last 12 or 24 months with those. You can have an asset depletion. Say you've got a large sum of money in the bank, and we just go ahead and use the asset in there, and we subtract so much out of it a year, making sure you have enough to do these loans. There's some loans out there more called stated income and stated assets or something. Those would be more along the lines of the hard money, because you're just stating what your income is, and you're not verifying it all.
Okay. Well, this is Rebecca and Brian, and until next time, keep it real. Estate.